Well, thank you everyone for tuning in and joining us on this Family Investment Company webinar. This one has been hugely popular. I think we had nearly 600 subscriptions, which just shows how much people, are seeking to understand family investment companies, and also just how popular inheritance tax planning is at the moment. We've seen kind of lots of changes recently, and yeah, it's probably the biggest area of my work, definitely at the moment, is inheritance tax advice. Um, so yeah, hopefully this will be quite an introductory overview to family investment companies. Um, yeah, so let's crack on. So the agenda for today, I'm going to give a brief overview about inheritance tax. We're then going to look at trusts quickly and an overview of trusts and their tax regime. Obviously, this is a family investment company webinar, but trusts are kind of seen as kind of a bit of an alternative to family investment companies. They are by no means one or the other. We have lots of clients that use both and potentially even put a trust in a family investment company structure. But it might be helpful if we just give a quick overview of trusts. Then we will look at family investment companies and it'll give the tax regime overview around that. A table comparing both. Dave will then look at the legal aspects and the key considerations on FIC structuring. And sorry, I actually didn't introduce my two speakers at the start, which I probably should have done. I'm joined by Dave Robbins, who is a corporate partner at Scown, and a special guest in Matt Fowler, who is the managing director and owner of Fowler Financial Planning. So from financial advisors. So delighted to be joined by both, and especially Matt, who's come as a guest appearance, which is great. So sorry, back to the agenda. And then I will look at kind of properties in family investment companies before handing over to Matt, who will talk about kind of managing funds inside a family investment company. If you haven't already gathered, a FIC is a family investment company, and that's kind of the terminology we'll be using throughout. There should be 10 or so minutes at the end to do a Q&A. So as we're going, there should hopefully be a question box. Has that appeared? Or if not, my lovely colleague Justine is going to give me your questions. If we don't get around to answering any during this, we have your details, so we should be able to follow up directly as well. Or please pop us an email. All of our email addresses should appear on the final slide too. So a quick inheritance tax overview. So inheritance tax is presently charged at 40% on death. That 40% feels like a huge number, especially kind of when you think that your whole life you're paying income tax, capital gains tax at quite high rates. Then you're paying kind of VAT on services and goods that you purchase. If you do any land transactions or anything, you pay stamp duty. And then what's left, your kind of beneficiaries or people you leave stuff to, they're taxed at 40% on assets that you leave. So it's a huge percentage. And, in some countries, they don't actually even have an inheritance tax. So that's why kind of we do so much planning, and family investment companies have become so popular, because people, fundamentally they don't want to leave assets and then there'd be a 40% tax charge on them. Everyone does have a nil rate band, so this is the amount that can be taxed at 0%, but it has been frozen since 2009. I think house prices since then have potentially doubled, and obviously with inflation, that now should be a lot higher. But that has been fixed at 325,000. Everyone also has a residence nil rate band. This is 175,000. And this is if you leave a qualifying property to a direct lineal descendant, you will also get this 175,000. So that's child, grandchild, etc. So combined, you could have assets of 500,000 that you leave free of inheritance tax. Married couples or civil partners can share these allowances. So if you were kind of the second death in your couple, you could potentially have inherited that 325 or the 175 and have £1 million worth of assets that could pass tax free. The residence nil rate band does taper off as soon as you have total assets that start going above 2 million. So we have to watch that. So that could be lost or tapered down. So that's just a very high level, broad overview of current IHT regime. But the big recent significant changes, as you probably know in the recent budgets, are around business property relief and agricultural property relief. Previously, these two reliefs were uncapped. So, if you had shares in a trading business, you're a partner in a partnership or a sole trader, and it qualifies, you wouldn't have probably even had to have considered an inheritance tax in the past because it was an uncapped business property relief. Or the same if you were kind of farming or you let your farm for a qualifying period. Again, no inheritance tax because BPR and APR were completely uncapped. Now there is a cap of 2.5 million for that 100% relief and 50% thereafter. So it's drawing a lot of people that kind of have businesses into now thinking about IHT because of this. And perhaps even bigger, and I'm sure this one's kept Matt very busy, is that pensions will be subject to inheritance tax from April next year. Pensions were previously a great tool. Obviously, you can save very tax efficient, put funds into a pension, saving income tax during lifetime, and then draw down on your pensions later, and equally outside of inheritance tax. But now with them being brought into the estates from next year, that's perhaps the biggest shake-up as well we've seen. So planning tools, there are a lot more than trust and just family investment companies, but those are obviously the two that we're touching upon today. Equally, if you just want to run away and leave the UK, my colleague Michaela is doing a fabulous webinar in 2 weeks' time on how the IHT regime has changed for non-residents. So definitely sign up and tune into that one because yeah, you'll find out whether if you can actually run away to avoid IHT here. So trusts, a quick regime for them. So a trust is obviously different to a family investment company. The fundamental of a trust is it is a legal arrangement. A settlor, let's say mum or dad, creates a trust and they provide the assets. Any assets could be property, cash, investments, etc., but they put the assets into a trust. The trustees, they're the legal owners of the assets once it goes into trust, and they manage the trust assets in accordance with the trust deed. The beneficiaries, they're the ones that are entitled to the income and capital from the trust. So this could be children, grandchildren, great-grandchildren. So that's kind of how a trust is structured and how a trust works. In terms of the tax regime on a trust, so assets moved into a trust are what we call CLTs. So these are chargeable lifetime transfers. So at the start, when I said the inheritance tax is a 40% tax on death, that was a massive oversimplification because what most people don't realize is you actually do pay inheritance tax on lifetime gifting as well, potentially. So by moving assets into a trust, this is a chargeable lifetime transfer, and inheritance tax is due at a lifetime rate of 20% if the assets going into trust go over your nil rate band, which, as we discussed, is 325,000. If you were to then pass away or die within 7 years of kind of settling that trust, it is potential that you're then brought in for the IHT at death as well at 40%. So you might have to pay a top up of inheritance tax as well from the lifetime rate to the death rate as well. So assets that go into trust can also benefit from agricultural property relief or business property relief. So quite often it's tax efficient to, move property into trust where those reliefs apply, such that there is no IHT payable on such chargeable lifetime transfer. It is also worth noting that 325,000 nil rate band does refresh every 7 years. So, with clients that start early tax planning, we can kind of, settle a trust every 7 years and benefit from that 325,000. Trusts are not a completely inheritance tax-free environment. Trusts that are part of the relevant property regime are subject to inheritance tax. And this is in the form of 10-year anniversary charges. In reality, the actual calculation is hugely complicated and is a little bit painful, but just very broadly, the maximum amount of the tax charge at such 10-year event is a maximum of 6%. It depends on lots of other factors, one of which being kind of whether you pay tax when your property entered the trust, but ordinarily, it's less than 6%, but just for ease, we'll say a maximum of 6%. Again, reliefs can apply. There are, as well as entry charges, when you put assets into a trust, there are also exit charges. So you want your asset to actually be distributed out to a beneficiary. We have to consider exit charges. But the key for inheritance tax is that using a trust will remove the asset from your estate for inheritance tax. So survive for 7 years after you've settled a trust, that asset should be outside of your estate, and therefore you've done some good inheritance tax planning. So from a capital gains tax perspective, when we transfer assets into trust, these assets are treated as a disposal for capital gains tax purposes. And most importantly, they're treated as a disposal at market value. So even though you're not making a sell, you're not receiving any money, you're transferring your asset into a trust, is deemed to be disposed of at market value. The good thing with trust is because there is an IHT charge, even if it's at 0% because it falls in to the 325,000, holdover relief can be claimed, which means we can defer the capital gains tax charge. And therefore, when we move assets into trust, we shouldn't be suffering both IHT and CGT because we can defer the CGT through a holdover relief claim. And that holdover relief can be on any asset. It does not have to be a business asset, which is one of the key differences of what we'll see with a FIC in a minute. So the income tax environment for trusts. So trusts are taxed at additional rates. So the highest rate of tax for dividend income at 45%, or if it's dividend income at 39.35%, which obviously is very high. However, then the trust will pay that, but when the income actually gets distributed out to the beneficiary, they receive a tax credit for the tax paid by the trust and a refund if they themselves aren't additional rate taxpayers. So if we have a distribution out to a beneficiary who has their full personal allowance, they pay no tax and they will receive a tax credit for the tax that the trust has already paid. So whilst the tax environment in the trust isn't great, tax relief is available once the distributions are made. Perfect. So looking at a family investment company, this is a massive oversimplification. Yeah, so a family investment company is a private company limited by shares. So I guess Dave will talk a lot more about the structure and the legals when considering setting it up, because it's fundamental the setup is right from the start. But it is just that, it's a company. But unlike a company, the key for family investment companies is that they are bespoke. So I don't think that we'll ever see kind of two family investment companies that are the same. It is really important that kind of the share classes and alphabet shares are clearly defined. Sorry, Justine's popping me questions which are already distracting me, which I'm going to try and ignore, but we'll get to them at the end. But yeah, it's the key is alphabet shares, so that mum and dad and children have different classes of alphabet shares. Mum and dad would have the founder shares, which would typically have voting rights, control, and potentially dividends as well. And children would have the growth shares, which would have rights to the growth and also the dividends. But yeah, as I say, no two FICs would be the same. We'd always seek to kind of tailor them to meet the client's objectives. So tax on FICs. So in the same way that a gift into a trust is a chargeable lifetime transfer, a gift of, let's say, cash or property or whatever it is into a family investment company is also a chargeable lifetime transfer. And there can be inheritance tax at that lifetime rate of 20% once we settle a FIC as well. However, in the case of a FIC, we can kind of structure this when we initially set it up such that we're not subject to the chargeable lifetime transfer tax. And this is ordinarily because we structure kind of the introduction of funds or capital or investments into the FIC by way of a loan. So I'll come on to a quick example in a moment. But let's say if I wanted to settle £1 million into a FIC as part of my investment strategy and succession plan, I would then settle £1 million into the company, and the company would give me a director's loan account back, owing me £1 million. We would always recommend that the kind of loan is repayable on demand, and there are a few other things to consider, such that we're not perceived to be giving value away, which does create a problem. But yeah, we can do it by way of a loan. The other way is potentially to issue shares. So I inject £1 million into the company and I'm issued with £1 million worth of equity. Again, there is no chargeable lifetime transfer tax because the assets in my estates haven't changed. I had £1 million before in cash, but now I just have £1 million in equity in shares. So there's no chargeable lifetime transfer. The other way we sometimes structure these is by using growth shares. This is typically for a company that's already in existence. So let's say we have a company in existence that's currently worth £1 million. We obviously, once we start giving or gifting the shares to the children for that company, there will be an immediate chargeable a chargeable lifetime transfer and IHT potentially payable. However, these growth shares would be a separate class of shares that would only allow kind of the children to participate in capital once the company, let's say, had reached kind of, we call it a hurdle value of 1.2 million. So anything kind of in excess of 1.2 million, the children would then start to benefit from the capital. So those are the three ways we often see them set up. It can be a mixture of all three to use reliefs, allowances, etc. Like I say, each one is bespoke and kind of it depends whether we're looking at an existing company as well or starting this thing up from scratch. So from a capital gains tax perspective, similarly to a trust, the transfer into the family investment company is again treated as a disposal at market value. Holdover relief can again be claimed, but this is only on qualifying business assets. And when we're settling a FIC in the first place, we're not ordinarily talking about qualifying business assets. So it is actually quite rare that we see holdover relief being claimed. Of course, cash is not a chargeable asset. So if we're setting up a FIC with cash, we don't need to worry about capital gains tax because obviously there is no disposal because cash isn't a chargeable asset. Once kind of the I don't know, whatever is investments, property, or are inside the company, the tax regime is the corporate tax regime. So any profits are subject to corporation tax at 25%. The rates can sometimes be 19% currently, but these are close investment holding companies. So ordinarily all taxed at 25%. But as you may know, dividends received by a family investment company are exempt from corporation tax usually. So actually, if you hold a portfolio of shares and they're earning dividends, etc., the rate of tax you actually suffer within your corporate is 0%. So that is a very beneficial tax environment. Income tax treatment. So we talked about the loan repayment to begin with. When you put your £1 million in the company owes you £1 million back. As the company's paying you back that £1 million, there is no income tax. It's just the repayment of a loan. So initially, whilst you're kind of drawing back down your £1 million or loan, there might not be any income tax for you to pay. Or otherwise, dividends, as they're declared kind of on the different categories of alphabet shares, salary, pension contributions, there's still good tax efficient ways of getting money out of a FIC. So to give a very high level example, so let's say the parents hold A shares, they have voting rights, so the parents maintain control of the shares with the voting rights, and they have rights to capital up to £500,000. So parents have set up this company with a £1 million loan. The children then hold the B shares, which have dividend rights and rights to 100% of capital above 0.5 million. We'll assume there's no dividend restrictions and the company yields 10% each year. I have to ask Matt if that's a good rate of return or not. But for illustrative purposes, so initially the company has no value. We've put in £1 million and we've effectively, as a loan, the company owes us £1 million back. So the equity value is nil. After year one, we have a £100,000 return, assuming a 10% rate of return. We suffer corporation tax, but the equity value has grown by 75,000. I won't go through each line item because you get the idea. However, after 10 years, if we assume a 10% rate of return, the equity value of these shares has gone past the 1 million. As we said before, the parent shares were capped at 500k. So the parents now have value of 500k. But most importantly, the extra value above that has now passed to the children. So the children's shares are now worth 561,000. And at 40%, there is a huge potential IHT saving. So by using this FIC, there is a big IHT savings. The growth has happened outside of mum and dad's estates. However, perhaps even better, if we use an example where the investments are earning dividends, because there is no corporation tax when the dividends for the company, you're not seeing that 25% deduction for the profits earned in the company. So without going through this line by line either, you'll just see here that actually the growth, because of the kind of the compounding of the investment and the income, the children over the 10-year periods at this 10% rate of return, shares are worth over £1 million, and the potential IHT saving is worth over 400,000. So, really, really big scope for big IHT savings. So I'm conscious of time, so I won't run through this slide because I feel like I've covered most of it off. But the slides will be circulated afterwards if you want to look more at this table. Maybe just some key ones to pick out are potentially the holdover relief one, I think, is quite a big one. So when we put assets into a trust, we can claim holdover relief for capital gains tax purposes, but within the family investment company, this is only applicable to qualifying business assets. So that's quite a big one. I think the tax environment as well is quite a big one. So companies obviously pay 25% corporation tax and 0% on those dividends, which is the really attractive kind of thing if we've got investments that pay dividends. But obviously trusts have a much higher income tax environment. They pay 45% on income or 39.35 on dividends, subject to the beneficiary claiming. The IHT regimes are obviously different. The trust is within the relevant property regime and is part of that 10-year anniversary charges. And potentially the other big one is as well is if you have a family investment company, obviously this is there's public filing requirements. So everyone's probably familiar with Companies House, which some people don't like, whereas trusts, obviously you need to be registered and there is admin, but the trusts aren't a public trust documents and trust accounts, etc., aren't publicly available documents. So there's much more privacy when you run a trust, which some people by far prefer. Yeah, so some key advantages of the FIC. So inheritance tax, it allows wealth to accumulate with children and grandchildren. So growth is outside the estate and you're not compounding IHT exposure. We retain lots of the same benefits as a trust, but it's potentially through all the different share classes and how, Dave will help you set it up. It maintains greater flexibility than a trust. Essentially a better tax environment as corporation tax rates are much lower and nil if it's dividends. And I think most people tend to kind of prefer family investment companies to trusts because they're just simpler to understand. Everyone has kind of, everyone knows how companies work and there's companies all around us. Whereas, I'm in some client meetings and as soon as you mention trust, before you've even gone on to explain how they can be useful, no, not interested in a trust because I think people just perceive them as being very complicated. Whereas a family investment company seems a lot easier to understand. So perfect. Over to Dave to talk about the structuring.
Brilliant. Thank you very much, Kelly. So, as Kelly said, my name is Dave Robbins. I'm a corporate partner at Scown Solicitors, and a good portion of my work is assisting clients with setting up family investment companies. And so, if we step back, what is a family investment company? So, Kelly's gone through all of the tax elements of it, but from a legal point of view, what is it? So, there isn't a type of company called a family investment company. It's simply a private company limited by shares. So many of you will already have, for example, trading companies that are this type of entity. And the difference with a FIC is it's what you use it for effectively and who the shareholders are. So with a trading company, you're doing it to generate a profit to benefit those shareholders. Actually, with a FIC, you're obviously trying to generate more wealth, but it's with that extra view of the fact that, well, we're looking ahead to the next generation and how we can get assets to them and value to them in a way that isn't going to create an inheritance tax problem. So it's private company. And then the other point, which is relevant to any company, we've got the difference between directors and shareholders. And so this is no different in a FIC. You've got the shareholders who are those who own the underlying value of the company. So they're entitled to the dividends. Any growth in value is going to accrue to them. whereas the directors could be the same people, but not necessarily. And whoever those directors are, they've got the right to run the company, to make the decisions. So it's the directors that will decide what assets are invested in, when are the dividends declared. Anything to do with how those assets are managed is the directors, but they're doing it for the benefit of the shareholders. And so, how do you take what is effectively a bog standard company limited by shares? How do you turn it into a family investment company? And so, the key document for this is a document called the Articles of Association. So, every company will have them. You can set up a company, and Companies House will just give you the default model articles. That means, the company kind of works, but it's all very standard. For a family investment company, you need a bespoke document that will say what rights do each of the people within this company have. And so the three key rights attaching to any shares are voting, who as a shareholder has the right to vote and have a say, dividends, which shareholders are entitled to receive any income out of the company, and capital in the event that, say, the FIC was sold or wound up, who is entitled to that underlying value. And so to take this example that Kelly gave, so this is probably a FIC at its most simplest. So you've got two different classes of shares, the A shares, say that mum and dad have got, and the B shares, which the children have. And you can have as many classes of shares as you want. You could have each individual person. Mum and dad could have A, B, and if they've got 10 kids, then they can have whatever that is, C through to L shares. So you're not restricted to just A and B, but for simplicity, that's the example here. And you can split out those voting, dividend, and capital rights differently on different classes of shares. So here is a common way of doing it, where mum and dad, but not only are they the directors of the company, and so they're deciding how the assets are used, actually at the shareholder level, they've got 100% of the votes. So if there are any particular matters where, under the Companies Act, as a matter of company law, you have to go and ask the shareholders, well, it's only the mum and dad who can have a say on that anyway. And you could say that the children have got no voting rights. Then when it comes to the income, it's quite common to say that there would be variable dividend rights. And so it might be tax efficient for a dividend to go to the children, not mum and dad, or vice versa, or you might want differing amounts. So you can say in the articles for the company that when you're declaring income, directors can do what they want. Because otherwise, the default position is if you didn't have alphabet shares and you just had one class of shares, everyone has to get a pro rata dividend. Similarly, with the votes, if you don't have special rights, everyone has a pro rata right, depending on how many shares they've got. And then at the capital level, if the company was sold or wound up, it will often say, if you've got 10% of the shares, that person is entitled to 10% of the proceeds. But that will very much depend on, as Kelly said, it might be that you've already got value in a company and you want to take it from, say, a holding company that already owns some assets into a FIC. It might be that you say, well, we're going to give 10% of those profits going forward to the kids, but anything up to today's value is staying with the parents so that we don't create a tax charge. But effectively, those three key rights, you can do whatever you want. The kids could have some voting rights. They could have some rights to vote on only very specific matters. You could give all the kids different, if you particularly preferred one of your kids to the other, you could give one of them a different class of share that had better capital rights, for example. It is completely flexible to do whatever you want to do. And so questions we often hear sort of very similar questions from people. And so one of the common ones is, if I set up this fixed structure and structure it so it's tax efficient, and so that when there's income and capital growth, it's going to accrue to the kids in a tax efficient way. Well, as a parent, I only want my kids to benefit from this. and maybe my grandkids. I don't want, these shares ending up with another person because this is the family wealth. Could that happen? Well, the default position is if you set up a company and you give someone shares, default position, there is no restriction on that person transferring their shares to anyone else. And so if you set up a FIC and it wasn't set up correctly, the kids could decide, oh, I want to sell my shares to someone because I want some quick money. So what people will often do is what we call bloodline articles of association, which effectively say that the only people that can hold shares in this company are the direct lineal descendants of mum and dad, for example. Or it might be that you say it's direct lineal descendants and those of their siblings. For example, you have this definition of, well, what is the family? And no one outside of that family is allowed to own shares. So if someone tried to transfer their shares, the directors of the FIC, mum and dad, would say, no, you're not allowed to own shares. It's in the articles. You're not having them. The other way of having that control over who can hold shares is having a restriction on transfer. So rather than saying you have to be a blood relative, it might be, for example, that the kids want to be able to give some shares to their spouses. So that if there was, say, a dividend declared, some of that would go to their spouse for tax planning reasons. And so it might be that mum and dad say, well, there's only going to be transfers if we agree to it. So if you want to give it to your spouse, if we say yes, you can do it. So, but in either scenario, mum and dad, who will have probably built up that value and are putting it into the company, they have that right to control who owns shares in the company. And then another question people ask is, well, what happens when I die? And shares in a company, in a FIC, will be dealt with like any other asset. So if that person who's deceased, the shareholder, has a will, they would pass under the terms of the will. Or if they didn't have a will, it would be governed by the rules of intestacy. But much like house, cash, car, any other asset, shares are governed by that process. But the important thing to note is, and it goes back to that point about well, who has shares in the FIC, is that the articles of association for the FIC can effectively override the will. So if, for example, we had bloodline articles that said only blood relatives of these people can hold shares, and someone's will said, oh, I want to leave my shares to my neighbor because I'm good friends with them, actually that that transfer under that will, that legal title of the shares, can effectively be overridden by the articles. It can get a bit messy because you say, well, I've kind of tried to pass on this value in my will, and the articles are saying, well, you're not allowed to pass on this legal title. It can get a bit messy. So the important thing from that is, although the articles can override the will, is to make sure that any shareholder in the company, their will marries up with the article. So it's drafted with the terms of the articles in mind so that you don't end up with this conflict. But there is always that backstop that the articles will govern who owns shares in the company. Then another question we often get asked is if I give 20% of my company to my son, could he go and just blow all of the money? Could he, take out all the cash? Could he go gambling, go to Vegas, just have a wonderful life and actually blow his inheritance and the family wealth? So the answer is, if it's set up correctly, no. So the shareholders in any company have no right to take or receive anything from the company. So it's your kind of default starting position is, well, the directors decide when your dividends come out what we're going to do with the assets. And so as a shareholder, they have no say in what happens. So that kind of protects the money because the directors control it. It might be that you have one of the kids as a director and any vote or decision at director level as a standard has to be by majority vote. So if you had mum and dad and a child, the child can never outvote mum and dad. But even if you wanted, say, your three children as directors and you had mum and dad, you can have, even at the director level, you can have certain voting thresholds to say, well, any decision of the directors is only passed if mum and dad agree to it. So regardless of if you got 3-2 vote, mum and dad are still in control. So it's an extra protection for that value. And then the other protection you can have is that certain shareholders, as a matter of law under the Companies Act, can remove directors. But actually, if mum and dad have a right to appoint those directors, actually the kids can't suddenly oust mum and dad and say, haha, we're the directors, we've got all the money. So you can protect the children and give them the money when you feel able to. And then the other question that we get asked quite a lot is, what happens if one of my children gets divorced? And so let's say you haven't got bloodline articles, and mum and dad have said, yes, child, you have a spouse, and therefore you are allowed to, for tax planning reasons, transfer some of the shares to them. Well, actually, sometimes parents might feel uncomfortable because they think, well, what if there is a divorce in the future? The default position would be, well, if someone owns the shares, they keep them, they're theirs. But what you can put into the articles for the FIC is to say that regardless of who instigates the divorce or how it comes about, in the event that child and spouse become divorced or divorce proceedings begin, the spouse is compelled to transfer their shares back to the child for £1, for a nominal value. And there has to be a transfer document that gets signed to do that. And you could also say in the articles for the FIC, well, if the spouse refuses to sign and says, well, I've got the shares, I'm not going to sign this document, you can have provisions that say any director of the FIC, say mum or dad, can sign that transfer form on behalf of the spouse under the articles to make sure that the shares come back into family ownership. The important thing to note here is that it ring fences ownership, so you can make sure that the spouse has to give back the shares, but it doesn't ring fence the value in that on a divorce, as a general point, the marital assets of the couple are pulled together, the value is looked at and then distributed. So it might be actually that if they are valuable, that is counted in the divorce and the spouse is entitled to some of that value. But then you would look at other ways of maybe financing that with other assets that the child had. Um, it, so you'd have to look at that at the time, but certainly from the starting point, the ownership of those shares and therefore any control that might come with them goes back to the child. I think Kelly now is going to talk about
Perfect. Yeah, thanks,
property.
Dave. I'm just going to rifle through this really quickly because I think Matt will need his allocated slot to talk about managing investments inside. But we get a lot of inquiries about putting property into a family investment company. So that is putting property into a limited company. So let me just cover off kind of quickly considerations here. The two big tax considerations when we look to potentially put this in place are firstly stamp duty land tax and then capital gains tax. So stamp duty land tax, probably we're all aware of it because we've all kind of had to pay it in the past. But the key thing when we're looking at putting property in a FIC is that even though there is potentially no consideration, we're gifting property into our own family investment company or whatever it is. Stamp duty, land tax is payable on the market value of the property, even though there's no cash consideration. So if I'm just to put a £300,000 property inside my limited company, I potentially have to pay £20,000 in stamp duty, even though there has been no consideration. It's special rules deem this as a market value disposal. So that can be one of the big barriers stopping, many people putting property inside of FIC initially is this stamp duty. So if you were to kind of, you want to put kind of 6 or 7 properties into a company, the stamp duty land tax burden is obviously going to be very high. On very rare occasions, there is a relief that can apply. I'm not going to go into that now, but it is quite rare and it would depend on specific circumstances. The other one is capital gains tax in a similar way to stamp duty land tax. Even though there's no consideration, again, it's treated as a market value disposal. So there is capital gains tax to pay. And because these typically aren't business assets, unlike a trust, we can't hold it over. So when we're introducing property into the company, again, capital gains tax could become payable. And these are the two biggest barriers that stop property going into a family investment company. So the stamp duty and the CGT. This table just is work I did 3 weeks ago for husband and wife who have 5 properties, and they wanted to introduce them into a company to do some succession planning. And we calculated the capital gains tax exposure if they were to do that. You can see that like some properties could be standing at a loss. So property number 5, actually it was stood at a loss. So actually the capital gains tax of putting that into a company, there wouldn't have been any because it was a loss. This couple actually as well had capital losses to bring forwards. I think that they were around about 200,000. So actually, we could do some planning and still get these properties into the company and avoid capital gains tax. But the stamp duty was still a bit of a problem, which we're still kind of talking about at the moment. Potentially incorporation relief does apply, but this is only where you're operating a property business. And it is very rare. Obviously, we would have a discussion with you about that. And potentially it means that actually repurposing a company that already has property in it is potentially a more attractive kind of way of um, using a FIC for property than actually transferring again and paying stamp duty, land tax again, which can be a bit of a barrier. I'm not going to talk about that because I want to give Matt his time. But yeah, the benefits of property in a family investment company, they're still there because it can still be much more tax efficient to hold property through a company. Rental income is taxed at a lower rate than if you were to pay tax on it directly and personally. You probably all know about the change in the mortgage interest relief rules, such that within a company you get full offset against the mortgage interest costs, but if you hold it personally, that's restricted to basic rates only. And it's still great for IHG planning, future property appreciation and growth outside the estates. But property in particular does come with these kind of stamp duty and CGT tax considerations that we need to consider from the start. Yeah, so over to Matt. Perfect.
Brilliant. Thank you very much, Kelly. And Dave. So thank you also for inviting me in to talk today. I think when we were talking before, talking about there's a lot of work that goes into why a FIC might be put in place, but then talking about what happens within it is the kind of natural next step. So I'm Matt Fowler. I'm the Managing Director of Fowler Financial Planning in Exeter. And a lot of the work we do with clients is around using investments for tax planning purposes. So whether that be putting in place trusts or managing investments within a FIC or other such structures, this is the core of what we do. And so hopefully we can add some colour to today. I'm just going to make sure I can, there we go. Oops. Sorry, there's a slight lag on my control of the slides there. So what we've had so far on the webinar is a walkthrough of what a FIC is, how the tax regime works, and how it compares with a trust. So my role now is to kind of pick up from there and actually talk about once the FIC's legal documents are signed, once the share classes are sorted, the tax treatment is understood, and there's capital inside it, what's it going to do? And so the conversation that we have with families and with their professional advisors is, what is the purpose of this money? So the reality is we always want to have a personal purpose before we get to the tax planning side of things, because a lot of what Dave's spoken about, a lot of what Kelly's spoken about is about control and access. Those are the two key functions of both trusts and family investment companies. If neither of those is important for you, and it's the unpopular kind of view for us as advisors, but if you don't care, you can just give an asset or give the money away. Yes, there are tax implications and so on you need to go through, but what we're talking about today is where you might still need some access and you may still want some control. And so with that, we then want to know what the purpose is. Is the access that you want? Do you want income? Do you want your family to have income? Do you want to control who has access, for example, like the bloodline articles that Dave spoke about and so on? And so once you decide that, should it sit in cash? Should it be a property? Should it be an investment? It's all of these questions that we need to understand before we can actually pull everything together. And in terms of what we typically see, most of the clients who we end up working with in this scenario come from two common starting points. So the first is normally an owner-managed business that has been really successful. They've generated more profits than they've needed or wanted to extract, and they've ended up with a retained cash balance on the balance sheet. Personal extraction becomes quite unattractive due to taxation rates, and there's no clear plan for the capital. It's no longer needing to be reinvested or distributed. And the second type is one that I know Dave and the team, Kelly and the team work with quite often as well. Often with trading companies, you have a holdco above it. And upon business sale, you might sell your trading co, your operating co, but then the holdco is holding the cash. And then we say, what do we do with that? And this is where increasingly it's unattractive to distribute the capital straight out. And a FIC is almost born naturally at that point, but it's got a load of cash and we don't know what to do with it. And so broadly, it's retained corporate capital that we see working with. And so obviously, we've spoken earlier today about opportunities to settle money into a FIC, which is already in your own personal name. We mostly see it from the other side where it's already in a corporate structure and we're repurposing what that structure looks like. And going back to my initial point, there are three key decisions that need to be made before any capital is invested. So it's purpose first. We want to know what that purpose is, who is it for, and once we know that, we can then move on to the second point, which is the vehicle. And by that, I don't mean FIC versus trust, because that has already been decided here. We're talking about what are we going to hold within the structure, within the FIC, in order to achieve that purpose. So I've seen questions coming in around property, question about pensions. I'm sure we'll get to the Q&A at the end as well. I'll make sure I don't use up all the oxygen before then. But there are vehicles which are tax efficient, both in trusts as well, particularly when you're introducing fresh capital. And so by being open to the advice of what you can hold within the structure, you can become more efficient with that vehicle from a tax perspective, as well as in support of the purpose. For example, if the purpose was to support grandkids with large capital extractions in the future to buy a house, having an illiquid asset in, illiquid vehicle in the company is going to be less helpful, for example, in order to get hold of the cash for it. And then the last piece is the governance. Who controls the decisions, the benefits, when can the income flow, what happens on death, divorce, or falling out. And so while Dave will have shaped much of this in the articles and shareholders agreement, we need to make sure the investment plan mirrors that and it doesn't get in the way of it. Exactly the same as when Dave said you need wills to mirror the articles and shareholders agreement. We need the same with the investment plan as well. And this is why having your professionals working together is so important on these kind of structures. So what I wanted to do was try and actually put those decisions together with a real life example. Now, this is a fictional one, but it's not a million miles away from the kind of examples we work with on a regular basis. So, in this case, I like to give a name so it sounds more realistic. So I've given Mr. and Mrs. Carter, who are 62 and 59, and they've recently sold their trading company. They've paid any taxes and so on the sale, and they've now got £3 million cash inside their holdco, which they've restructured as a FIC, with help from Kelly and Dave in this example. But because for them, they've got their 2 adult children, 4 grandchildren, they don't need any personal income right now, but what they want is control, liquidity, estate planning, so IHT planning, and fairness across the children. And so that's where the FIC becomes a really important opportunity for them from a purpose perspective. But then we say, well, after we've got those family objectives, do we leave it as cash? Do we invest in a property within the FIC? Or do we put in place a portfolio of managed investments, which is broadly where we come into this? Or do you extract it and then put it into a trust? Now, extracting and then putting it into a trust, we've had the entire webinar this morning explaining why that is least likely to be the best option. And what we've illustrated across here is on a 5 and 10 year time horizon with a number of assumptions, which when the slides are distributed, you'll be able to read on the right-hand side here to show how over time managed investments are increasingly and incrementally the best solution. not only because of the expected returns, but also the tax profile and the liquidity profile of them. And so, as I say, you can read through it. I know, Kelly, you asked the question of is 10% a good return? You know what? The last 3 years, if anyone has a medium risk profile or above in their pension, they haven't had 10% a year, then that is, they've probably got the wrong investments, if I'm being perfectly honest. But this is an unusually high period. The FCA always likes us to assume it's going to be dour forever and a day whenever we have to give FCA forecasts. But broadly speaking, cash plus, say, 3%, 3 to 4% over the long run is a sensible gross assumption for investment returns for a medium level of risk. Now, obviously, these aren't guaranteed. There's risk with it, same as with property and so on there. But the reason for trying to move away from what's going on in the markets at the moment, which has been an unusually tech-driven, high-yielding period, is because mostly people use FICs, people use trusts because they want multi-decade planning. We therefore need to be calm and collected with the reasons for going into it, but also what we do with it. And so, as I said, from our perspective, the investment thesis then that supports the family objectives strongly shows that investments are more likely to be the better return over the long run, and increasingly the longer time horizon you have, than property, cash, or even extracting and putting into a trust. And as I say, we do a lot of trust work, but mostly our trust work comes from capital already held directly by the clients. I won't go into too much detail here, but this is the bit where we have to kind of earn our stripes and work very closely with Kelly and her team here. At a high level, there are accounting basis rules we need to consider, and this is specifically talking about investments within a FIC here rather than property or cash within a FIC. So different investments report under different rules. So FRS 102 and FRS 105 are the key ones we need to be aware of here, can have different tax treatment. So when we talked about earlier dividends not being taxable, there are unfortunately occasions where they can be taxable. So it does mean that we need to be very careful with the kind of investments we hold. So, funds with at least 60% in interest-producing assets generally fall under loan relationship rules, and dividends are treated as franked income and may not create any additional corporation tax. But it goes down to the weighting within those funds and the assets that we hold there. So we have a dedicated investment management team who manage portfolios in these kind of structures to ensure that we comply with the accounting rules to get the most favourable tax treatment for Kelly and the team to ratify, hence the working together piece. And that's a really important consideration for us here. And then also some of the kickers are that if structured correctly, often the advice fees and VAT can be offset or reclaimed through the company as well. So it's always nice to know you can kind of get something back for having taken the advice. From our perspective, this is so important to get right, but we can only get it right, as we say, once we've got the purpose sorted. And just to kind of bring kind of my short section together, the best outcomes for you as clients comes from a joined up advice before decisions are locked in. So it's not a case of jumping in and structuring a FIC and putting some assets in because we've got the accounting advice but haven't spoken to Dave. Or if you've spoken to Dave and haven't spoken to Kelly, haven't spoken to us, it's really important to make sure that you engage with solicitor, accountant, and the investment strategy side of things as well before you go ahead with a plan. So a joined up conversation with all three parties can prevent expensive decisions becoming embedded, because often with these, you want to get it right, so you only have to make that decision once. So what I'm trying to do is I'll wrap up now because I've kind of got 5 minutes left, and Kelly, I'm sure you want to try and get some of the Q&A done.
Yeah, perfect. Thanks so much, Matt, and to Dave, and I hope you've all found that useful. We do have quite a few questions in the question box, so let me start from the bottom and work up. If we don't get to your question, we will follow up directly via email, so do not panic. The first one, do the gift with reservation rules affect family investment companies? I think that's one for me. Yes, absolutely. So for those that don't know, the gift with reservation of benefit rules are where we give away an asset, but we're still deriving a benefit from it. It's easier to actually probably explain via a trust. So let's say if you put kind of your holiday home into a trust, and then you continue to go and stay and use that holiday home, you are affected by the gift with reservation of benefit rules, and actually that gift into the trust could be unwound as if it never happened because you're still benefiting from the assets. So it kind of undoes the tax planning. I guess in relation to a family investment company, we can still have that in terms of kind of the control and income issues. So if you were to give shares to your children, but you were to, and their dividend shares, but you were to then kind of effectively take the dividends or income arising to those shares, again, the same would apply. So if you give shares to your children that have control, but actually you're still controlling the company, um, that would apply. So it definitely still can affect FICs, just in a slightly different way to trusts. One for Matt. Matt, can you see the questions, or do I need
I
to?
can, yes.
Oh, fine, fine.
So is this the anonymous NT, what is the FIC notes available question? So in very short, it just means we don't structure them. It goes back to my point. So between Dave and Kelly, who cover the legal and accounting side, we then can cover the investment side within it. So that's where either through our core portfolios or our investment management division, we then act with the company as our client.
Yeah, great. Okay, perfect. And then Kelly mentioned IHT point, value outside of mum and dad estate. Is there any further info on this? Yes, so on the Gravita website, we actually have a succession hub. And I think we have quite a few articles there that I know I've written one about family investment companies recently. And we've got a little video explainer as well about family investment companies and more numerical examples. So definitely go and have a look at the Succession Hub on our Gravita website, which Justine will include in the follow-up as well. So more information there. Can a property based outside the UK be placed into a FIC? Yes, it wouldn't be exclusive to the UK. I guess the biggest point here would be taking local tax advice in the jurisdiction that property is also in. It could cause lots of complexities having not only a overseas landlord, but an overseas corporate landlord. And there could be other tax issues that we would have to consider in conjunction with the overseas jurisdiction as well, which might make it a little bit more difficult, but no reason why not. Um, Fine. Dave, maybe one for you on the bloodline question. How would this work during divorce? Would the shares be considered an asset of the child, shall we say, and potentially be broken up during divorce?
So on the shares would be but belong to the child, say if there had been a divorce. So when the divorce proceeds, the starting point is, well, the legal ownership belongs to the child, but in the matrimonial proceedings, the value of those would go into the pot, and then say there was all the assets together were worth £1 million. You'd say, okay, well, the two spouse and child are entitled to 500,000 each. It might be that the child needs to realize the value of those shares in order to give some of that cash, some of that 500,000 to the spouse. It doesn't mean that the actual shares would go to the spouse, because we don't normally see that the court would want to give a family asset that, the court can see that it's designed for the family, they don't want to give that asset away. But it might be that the FIC had to, for example, go to Matt, sell some assets to get some cash to buy back some of the child's shares to give the cash away. So they wouldn't have any ongoing ownership, but that asset might have to be realized in order to get the cash out to them.
Yeah, great. And I think that answers the question above as well. We've also had on the point about divorce and the shares. Matt, potentially can a pension pot of a parent be transferred into a family investment company?
And so pensions are held under master trust arrangements, and so you'd have to liquidate it, pay 45% tax on the most of it before putting it in. So it wouldn't necessarily be a good decision there.
Yep, agreed. Can a child under the age of 18 be included as a shareholder in a family investment company? Yes. And one thing that I actually didn't cover in the webinar, because then it would have been about 4 hours long, is all the tax anti-avoidance legislation that kind of governs them. There is so much tax anti-avoidance that we have to watch out for when setting up a family investment company, governed by kind of the general anti-abuse regulations by HMRC, that it isn't aggressive from a tax perspective, and there are all sorts of settlement legislation rules, which is where HMRC would be perceiving you to shift value into those lower income rate taxpayers, particularly the parental settlement rules, which applies to the minor children. So yes, they can hold shares, but the income would automatically be taxable on mum and dad if they are minor shareholders. And there's kind of other things when we're setting up the FIC that we need to be very mindful of, that I haven't gone into the detail of because we would be here for a while. But obviously, if you were actually going to enact this, we would make sure all of that is covered off. Can you put property into a FIC? I think that question came in before the property bit, so hopefully that's helped. Can you see any more, Dave or Matt? That when you say no tax on dividends received by the FIC, is it irrespective of the country of origin? It kind of depends. Some countries, so in the UK, we don't apply a withholding tax on dividends. So where we're receiving dividends from UK companies, there is no withholding tax, which is a bit silly, but there isn't. But if you're kind of invested in overseas investments, there could be withholding the tax that's applied. And I think Matt's got something to say on this as well. Have you, Matt?
Oh, no,
Oh,
sorry. I
no.
was just trying to clear out the questions for you so you could see which have been
It
answered.
said Matt would like to answer this question. Fine. And then excellent webinar and speakers. Thank you. Thank you very much. What are the rules relating to running expenses through a family investment company? Matt mentioned advisor fees, but can parents expense other plausible management related fees? It's a good question. And actually, yes, expenses for kind of management, etc., can definitely be taken off against the corporate tax liability. And that is one of the other advantages compared to holding these investments personally, because if you hold them personally, obviously there's no deduction for plausible expenses of management expenses, etc. But in a company, they can be valid management expenses and you can get a deduction.
Do you want me to take the top one about the DGT
Yeah,
quickly?
great. Yeah.
So broadly, a DGT, for those who don't know, is a discounted gift trust, and that's actually a very separate thing. I think what's being referred to here is a loan trust. So if you put money into a loan trust, you are loaning capital in, the growth is outside your estate, but you normally take a tax-free income from it, which repays the loan over time. So that then becomes very similar to loaning money, fresh money into a FIC. So yes, that would be similar. A DGT is a separate thing, which is actually a really powerful tool and one for another day. But those are always worth looking into.
Perfect. In relation to the declaration of dividends of differing amounts to different share classes, how do you avoid any issues with regards to the settlements legislation? I think I touched on that a little bit, and it's a question that would take to answer in completeness. But I think the key is that kind of when we set it up, it's overarching is that we have a genuine commercial rationale. So we're not setting this up for wholly for the purpose of avoiding tax or tax motivated. We're setting this up with genuine commercial rationale, but we do have to be very careful with, like you say, the settlements legislation. And the tax GAR, which governs this all. So it can be done, but definitely the settlements legislation is something we would watch out for to make sure that it couldn't be defeated by HMRC because of all the legislation that exists in this area. Fine. And putting your main residence into a trust doesn't create any benefits issues, does it? It absolutely does. So if you're to put your kind of, it comes back to the gift with reservation of benefit rules. It can create big issues if you put your main residence into a trust because you're then benefiting from that asset if you continue to live there. Your main residence as well also would qualify, kind of not putting it into a trust for the residential nil rate band. So sometimes it can be a bit counterintuitive to actually put that asset into a trust anyway. But it does create issues with the gift with the reservation of benefit rules. So we would have to look at that in more detail. We can charge rent sometimes to get around that, but yeah, it is definitely something we would look to advise on because it is a bit of more of a nuanced area with rules.
I think a little health warning on that one, Kelly. I've seen a lot of unregulated adverts
Yeah.
proposing that on kind of social media and so on, and it is one that some odd care related cases it can make sense, but it is very nuanced. So, like I said at the end of my slides, don't rush into any decisions, and please do take proper advice.
Yep, definitely, definitely. I think we've got around to all of the questions. But obviously I've just put our email addresses all on the screen. So if you do have any kind of follow-up emails, we will circulate slides, and the webinar recording, if you want to go through this again, will be available. But yeah, thank you all so much for your time. And yeah, thank you very much.